So you want to know how some of the richest people in the world end up not paying money in taxes? In this video, I'm going to give you probably the biggest strategy that majority of them use. And if you stick around to the end, I'm going to show you how you can take this strategy to the next level. So why do most rich people own real estate? It's because of the depreciation. You can make money in real life. You can have real cash flow coming in. That's money in your pocket, but you can take a loss on paper and offset your taxability, right? It's called depreciation through real estate. And this sounds crazy, I know, but let's take a look at an example of this. So let's say you have 3 single family houses, and each one of these houses, after your principal, interest, taxes, insurance, etc., make you $300 per month each. So if you add that up over a year, that's $10,800 of income that comes in every year. So this is real cash in your pocket. This is profit that comes in after all your expenses. So let's take a look at the depreciation on these properties. So let's say you bought each property for $250,000 each, or let's say your cost basis is $250,000 each. So you cannot depreciate land. So let's say the land on each of these is about $40,000 a property. So you total value $750 grand minus $120,000 because that's the land value. So your total, cost basis is $610,000. Actually, it's $630,000. Working on my math here. So $630,000 of basis, and then you divide that by 27.5 years because you can depreciate real estate over 27.5 years. So you take that and you divide it over 27.5 years. That gives you $29,909 per year that you can take in depreciation. So think back, meaning you made $10,800 in actual cash in your pocket, but you're able to take $29,909 a year in a loss on paper, meaning there was no income. You actually lost more money on paper than you actually made, which means you may not have a tax liability to pay on the money that you have in your pocket. So there's different ways to offset, passive losses with active income and all these other things, but you got to technically be a full-time real estate investor. By the way, I'm not a CPA, not offering legal advice. Talk to your own CPAs. But if you're a full-time real estate investor, there's ways to be able to offset other income with these losses as well. So maybe you're not in real estate full-time, but what a lot of these people do is they'll actually get their spouse to get their real estate license, and then when they file together, technically one of them could be a full-time real estate investor. They could offset passive losses with other gains. But here's the huge kicker. Here's where the big opportunity comes in. So same scenario, we're just going to do this on one house to simplify it though. So you have one house that you purchased for $250,000, subtract the land basis. So your basis on this property is $210,000. So you can actually do what's called a cost segregation study on this property or an apartment building or whatever the property is. And instead of depreciating this over 27.5 years, when an engineer goes in and does a cost segregation study, they calculate different things that are worth different speeds of depreciation, which means you can speed up a lot of that depreciation into year one sometime, which you typically end up with like a 30-ish% write-off year one. Now these laws are changing. They are getting stepped down a little bit over the next, 2023, 24, 25, 26, etc. So definitely consult with your own CPA, your own attorney, but you can take a huge loss. So in this example, $210,000 times a roughly 30-ish% write-off is $63,000 in year one. So $63,000 you can write off in year one. From a cost seg study, if you're at about a 30% tax bracket, that's $18,900 in actual taxes that you would be paying out that you can actually keep in your pocket. Now listen, there's a lot of variables that come into play here. Are you married? Do you have dependents? What's your overall total income? Are you a full-time real estate investor? Or do you make your money elsewhere, right? There's a lot of variables that come into play with this. So highly recommend to talk to your own accountant, your own CPA. But again, I've been doing real estate like 7, 8 years now, and it's my main stream of income. So being a full-time real estate investor, I do this all the time, right? I take the depreciation, I do cost seg studies when the deal, makes sense to be able to go out there and do a cost segregation study. All of my friends that are in real estate do this same exact thing. Because at the end of the day, it's never, ever about how much money you make. Say you make $100,000 in a year, right? 100 grand, great money. But then you got to pay taxes on it. And you pay, 30% in taxes, meaning you only actually take home $70,000. It's never about how much you make, ever. It's about how much money you actually keep, because another person could make that same $100,000 that you made, but guess what their tax bill is? $0. So you made the same amount of money, but they took home way more money than you did. It's never about how much you make. It's always about how much you keep. So if you want to start taking advantage of strategies like this, first you need to actually own the real estate to be able to do that. So if you want to learn how to buy cash flowing real estate properties without using much of your own money, check out this next video.